Hello friends, this is your host Rakesh Kumar. In the previous video we had discussed about the morning star pattern. In this particular video we are going to see a few examples of the same, and we will switch to some securities and stocks charts, because the morning star pattern is available readily in those charts rather than the currency charts where we don't have gap up and gap down. Without further ado, I will just begin this video. Just to remind you that if you have not subscribed to our channel yet, then you can subscribe to it now to get notifications of the latest video uploads. And if you find this video useful for you, then please consider pressing the like button, which is just below the image.
But before we begin, let us have a look at the risk disclaimer. It states that the futures, stocks and the options trading involve substantial amount of risk. Your capital is at risk, the losses can exceed the investment. The information is provided as is, and the user of the information assumes the entire risk of any use it may make or permit to be made. So let's get started.
Okay friends, to dwell into the examples first, we need to know how the morning star looks like. Well friends, first of all we need a downtrend for the trend reversal to take place. This is a candlestick pattern which gives you a bullish candlestick reversal. I don't know how to draw this one. So after a downtrend, this candlestick appears. There is one red candle in the downtrend, and this red candle is followed by a small candle which is gapping down. Okay, it is coming like this, and this candle may be green or red, it doesn't matter, but here we will show it red in color. That means there was a downtrend, and then after there was even a gap down, showing that the sellers are much interested in okay, the sellers were much interested in selling at the market rate, and they sold the market on the following day also with a gap down. That means in the beginning of the session only they were ready to sell at any price, but on the third day there was a gap up opening. Okay, there was a gap up opening, and this candle can anywhere go in between this previous day's candle, and it is more reliable when it closes near the high of this candle, or even better than this one. Now talking about the wicks, these candles have very less wicks here. This candle can have larger wicks, okay, it doesn't matter, but this candle here should have very small lower wick. So this is how it is going to look like in the market, in the ideal market, but this is what you have to look for in the real market to trade. In this case, you open a buy position at the close of this handle, at the close of this candle, and you have to keep stop loss below the low of this candle particularly. Okay, and you have to target that depends upon where is the next resistance level, and as per that we will take the trades. So to begin with, now this is the first that I'm going to tell you. You also have to keep in mind that this candlestick pattern occurs at some sort of resistance or support. Now since we need to buy, so we will see where was the previous resistance. As you can see in this case here, there was a reversal. In fact, there was a reversal 3 times, and then when finally candle broke through it, it also acted as a support for the next day, and again acted as a support. This level acted as a support here also, and this time when the price was here, again this was acting as a good support for the price. So we can safely say that this level is an important level. So now when the price was coming here again, we were expecting some positive response here, and we saw suddenly a gap down opening with a positive close. So a gap down opening with a positive close, so the gap down opening with a positive close indicates that there is a possibility of morning star, and the following day there was a candle which opened higher and closed into the body of the first candle. Now this is the confirmation that now the bullish the bears have exhausted their selling, and at support the demand has come for the stock and it is now going to take it higher. Now this is all you have to look for. It is not that difficult, but this situation arises not very frequent, it is very rare. And where we have to target and where should be the stop loss and take profit, that I will just let you know. Now this candle closed here, you can immediately open the trade at the close of this candle or just before the closing of this candle, say 5 minutes before closing this candle, because this candle closing positive is an indication that the market is now going to go high. But where will be a stop loss? Ideally I should keep my stop loss below this candle, but you can also keep stop loss below the low of this candle also to be more aggressive. But I am very conservative trader, so I will wait for the price to actually go high and then maybe come back somewhere near to this level. But yes, my stop loss will be below this candle, and also I need to see where was the previous resistance. In this case this was the previous resistance, then I will have to measure from my stop loss is 242 points or say 240 points. So I need at least 720 points move, which is not here there is a possibility of only 443 based on the previous data, and actually the price did not even move to 700 points. So the pattern did not achieve good risk to reward ratio. See, this pattern does not have measured targets. Okay, this is what we are doing from the risk to reward ratio perspective. So the candle is good, the low is good, everything is going good, but this trade I will not be taking because this is having a very less risk to reward ratio. This is just 1:2 I think. Okay, we are risking approximately 240 and we are having an expectation of 440, so this is not a good risk to reward ratio. Those who trade with 1:2 they can do it. I trade only with 1:3 or more, otherwise I don't trade this. So this is a good for learning that this is how a morning star looks like, but this is not going to be a good trade. Talking about the second example here I will show you that this thing happened at support. This thing happened at the previous support level, but okay, just see what it was. The price was in downtrend and it was showing you bearish candles, much bearish candles. See here. And the third day when there was red candle, when there was a gap down opening, the price kept on going down, but the next day it opened up higher and did not see a lower shadow. You can see the bulls were entirely in control of the market and they closed the day in the body of the previous day's candle. If you remember that these three candles are forming actually the pattern, so we need to see only these three candles. So first candle was a bear candle, second day was also a bear candle, but third day was a positive Marubozu, and it confirmed that now the buying is going to happen. And if you are going to buy this one, you need to see your risk to reward. Here is your stop loss, here is your opening price, and you need to check how much you are risking on this one before you go and buy this. So you are risking 811 points, you need 2433 points in order to take this trade. Now this was the previous level of resistance where you can expect the price to go, so we need to measure the move from here till this point. It is approximately 2230, which is approximately 1:3, so we can go and go ahead and take this trade. But to manage this trade in between when it is going on, what you can do is that when you get target equal to your stop loss, now it is 800 points, when it moves 800 points into your favor, you can bring your stop loss to the break even. That is a very good idea, because most of the time if you see when you do your Fibonacci from the low, when it makes a high and starts coming back, if it comes more than the 50%, then it is not worth it. So when the price from here moves 800 points, it will not come to your level if it comes to your level, then you should not want to keep this trade open for you, because in that case it would have broken this 61.8% in an uptrend, and when a 61.8% in an uptrend is broken, that is considered as a trend break, and the price will continue lower. So you don't want to hold a position where you have no chance of going up or in your favor. I hope you get it. More about this, how to use Fibonacci in the trade management, I will explain you later. And one more example I just wanted to give you is that it is not as reliable as the pattern here, but you can notice that in this one, this pattern was a success, because it was, one thing is that it was right on the support level in the demand zone, one thing. Second thing is that the third candle of this particular example was a very good Marubozu, and the next day it followed with a gap up and the trend continued to the upside. So this is a very important aspect. You see that there was no gap up, but even after just opening the price on the third day, the price kept on going to the top and closed near the highs of the day, which was also near the opening of the first day candle. So this is very bullish in nature. Now before I finish this session, please bear in mind that opening the trades are much easier than managing them. I would request you to learn all proper risk management before entering any trade. A piece of advice from me is that never put more than 1% of your capital at risk on a single trade. I always say so. And you open the position only if you have a solid risk to reward ratio, which is of course 1:3 at least. If you find this video useful for you, then please press the like button below the video. If you have any suggestions or if you have any comments, you can write them in the comment section. If you have any questions, you can raise them in the comment section. I'll be ready to answer them in my next videos. Hope to see you in the next video. Thank you very much for watching.